Welcome to this week's Q&A. I hope everyone's doing really well out there wherever they are. I just wanted to say that we're getting a lot of questions about similar topics, and this week's one is a very interesting one from a client of ours, an Australian expat who lives in China, in Beijing, and his question is around capital gains tax treatment if he sells an Australian property asset. So here's his question. He has an option to purchase housing in Singapore at a subsidised rate, but to do so he needs to sell his Australian properties. And he's saying, what are my options? So I've got this written on the board behind me just for people to have a look. What happens as an expat, as a non-resident, if I sell my properties, my investment properties? Am I liable for 100% capital gains tax? And the answer is yes, you are. There is no discount for capital gains tax purposes, which is a tax that's imposed on assets that are held for a period of 12 months or more, which are income producing or investable assets. And if you're living in Australia, however, you can then claim a 50% discount on your capital gains tax on that manner. So what actually happens? If I sold a property and I made a capital gain, the amount of the capital gain is actually added to my Australian taxable income, or ATI as I have it there. So as our client asks, is that taxed at 32.5%? Well, that depends, because Australian taxable income for non-residents is taxed at 32.5% from $1, but then it obviously scales up as do the bands in Australia for Australian tax residents. So it depends on how much other Australian taxable income you have, and more importantly, I guess, for expats, depending on whether they've bought new dwellings or old ones, is to see how much they've built up in tax credits, because this is when these sort of things can really become valuable to you. And if you've bought a new property or new properties that have high non-cash allowances or depreciation allowances via Division 40 and Division 43, you might be off in a really good position because you've been able to claim these deductions without actually spending the money. So one of the things that happens if you build a new building in Australia, you can claim 2.5% of that building cost each and every year for 40 years. And similarly on fixtures and fittings and other inclusions under the two divisions, you can claim that over the period that the ATO says is a relevant lifetime for that type of asset. So you may have built up a really nice sort of bank of tax credits, and we can use that to offset that against the capital gain that you might make against your other Australian taxable income. So more important from that regard, is it new or is it old? As often happens with these things, it's it depends situation. So, if you've held the properties for perhaps 2 years, your deductions may not be as high as if you've held them for 10 years. And that's just something that we'd have to get the accountant or the tax advisor to do some sums on and work out exactly the situation for the individual taxpayer. So then another part of the question was, if I come back to live in one of those properties for a year within 6 years, can I claim that as a principal place of residence? Or is that not an option for a non-resident? So quite a number of questions in one again. Yes, certainly you can go back to Australia and you can live in one of your investment properties and turn that into your principal place of residence or main residence for tax purposes. Whether you come back within 6 years or not is irrelevant, because you bought that as an investment property, so it's only going to become your principal place of residence once you start residing in it. So also by default then, clearly you're no longer a non-resident, because you're now residing in Australia, living in Australia, in that house which has become your principal place of residence. You then are able to, from that point forward, let's say you went back overseas potentially and worked, wherever it may be around the world, you could then perhaps look at the exemption for 6 years, but it's not relevant now since 1 July last year for non-residents. So the 6-year rule doesn't really help as much as it used to. In fact, it doesn't really help us. So yes, you can turn that into your principal place of residence, and if you then sold that, say after 12 months of living in it, the benefit would be that you would get the 50% reduction on capital gains tax, because you're an Australian tax resident. You would have that obviously though on a pro rata basis, because prior to you living on it, it was an investment property. But it's all treated as if you are an Australian tax resident, because at that point in time when you dispose of that asset, you actually are. And if you've saved up sufficient tax credits, or a good quantum of those in the interim, in those previous 6 years, you could be in a pretty good position all up in a situation where you actually achieve a pretty healthy capital gain without having to pay too much in the way of capital gains tax. So then another part of the same question was, can I put these properties into a trust so I don't own them any longer, and thereby I try and do that without paying any stamp duty or capital gains tax? So, I mean, the simple answer is no, you can't. And the reason is because put's not really a legal word. You can't take the properties and put them into a trust. It's a disposal, hence a sale. And a disposal will always incur capital gains tax if there has indeed been a capital gain, and this thing would have to be done on an arm's length basis from a valuation viewpoint, and stamp duty, because it's a transfer from one entity or one natural person to an entity. So that's probably, again, it needs to be looked at in terms of how are you then placed in relation to the costs that are involved in this disposal or this sale from yourself to a trust. And also you need to look at the other costs which people may not first recognise or know about or think about, and that in the different states within Australia, the state offices of state revenue look at these situations in different lights. And if you're putting it into a discretionary trust, which most people will do, a family trust, there are different barriers, if you like, or different thresholds for land tax. Something you need to think about in terms of ongoing costs of that transaction and how worthwhile that may be. So, lastly, client said, well, it seems that these tax considerations could be quite onerous, and it seems like you should never sell your properties unless you go back and return and live in Australia. Well, I'd probably go one step further than that and say, unless you have a reason to sell them, you probably shouldn't sell them at all, because why incur any expense? Why incur any capital gains tax if you don't need to? And we often tell our clients that, because unless you've got a better use for the monies, what happens over time is that rents generally will go up with CPI, or perhaps at a greater rate than CPI, especially in this sort of depressed interest and CPI rate world that we live in. So I think that's important, because over time those properties will throw off a lot of free cash flow. So we have clients who might have bought a property 15 years ago, and now they're lamenting because, of course, all those negative gearing tax deductions have gone. They can't offset that against their other personal income, their personal exertion income. And the reason for that is because these assets are now producing way too much income and throwing off free cash flow, even after they're still paying for their mortgage obligations or their loan obligations. So the idea is, if you don't need to do anything else with it, keep these assets, let them tick along and appreciate in value, because over time, whether you reduce the level of debt or not, as a percentage, the LVR, or the loan to value ratio, will continue to fall as the value of the asset over time increases, and the value of the debt either stays flat on an interest-only basis or declines over time if you're repaying it via a 30-year P&I mortgage. So that's something to bear in mind. And it's not necessarily a case of, I should only sell them when I go back. I mean, you've got to look at it and say, why should I sell it? Do I need to sell it? And with this question as well, you've got to look at yourself and say, well, I've got an opportunity to buy something that's subsidised, but over the next 5 and 10 years, how would that equation look if I kept my existing assets and look at what they do, or if I sell those now, incur the costs, buy this other asset, how's that all going to look? No one has a crystal ball, but it's certainly very worthwhile to spend a bit of time and effort and get some advice in relation to how that would pan out. And that might give you a pretty good indication of whether you should actually embark on that or not. And I think the good part is that, you know, this person has some good investment properties in Australia at the moment anyway. Most economists now have come out and said that they anticipate that over the next 2 to 3 years we're going to see 20 to 30% growth in most Australian large regional and capital city markets. There was a story out yesterday from Commonwealth Bank upgrading their growth forecasts, another one from NAB recently. But you've got to look at where those properties are in relation to how much you might see of an increase. I think it's going to be pretty healthy in most areas as long as you own quality assets in a sought after location. So I think there's very little downside to all that. But it wasn't actually just a quick question, it was quite a lot of questions. There are lots of things to think about there, and quite often if you go and ask for advice, people simply answer the question you've asked, which may be 100% correct, but you may not have asked other questions which actually you should be asking to give yourself a far better chance of determining what the best course of action is for you. So look, I hope that's been helpful for our client who's asked the question and for our viewers in general. As always, I try and pick things that a lot of people ask about in a different way. So we've had numerous questions about this over the course of the last few months, and I hope that really helps people to get a bit of an idea and understanding of what they should be looking at. If you feel that you need more information about this, please don't hesitate to reach out, and we can always book a personal Zoom meeting to go through things if I don't know your background situation. In the meantime, all the very best. Hope you enjoyed it, and see you next Tuesday's Q&A. You can follow us on LinkedIn, Facebook, all of our social media pages to get updates as we bring them forward to you. Thanks once again.